But moving on, Godrej Properties reported a stellar set of Q1 earnings. The company's bookings rose 300% on a year-on-year basis, and the company remains confident of meeting its FY25 guidance. Our colleague Sonal caught up with Gaurav Pandey, the Managing Director and Chief Executive Officer of Godrej Properties, and began by asking him about the likelihood of the company beating the guidance and also on their launch pipeline. Listen in.
We have a very exciting launches planned for the year. As you would have noticed, we gave a launch guidance of about 30,000 crores for the year, 29% of which we've already managed to hit the market with. And thankfully, we are seeing great momentum continuing for us in all the large geographies where we are present. So just to give you a hint of some of the launches that we're looking forward to this quarter and the quarters beyond that, in Mumbai, we had a stellar launch of a project called Godrej Reserve in Q4, which became Mumbai's largest launch ever. And we have very exciting phase opening of that likely within this quarter. And we look forward to some stellar record also in that. Moving up in North, we have quite a few launches planned back to back. We have something coming up in Gurgaon Sector 103. Then we'll have 2 launches in Gurgaon subsequent to that in Golf Course Road. We have something we had acquired from Noida Authority in an auction, which should hit the market later part of this year in Sector 44 Noida. And if we go down south, we have a series of launches planned from Yashwantpur, which is a very important new micro market for us, to something in North Bangalore. Then maybe a launch in Hyderabad, if not 2. And in Pune, again, we have a series of launches planned, from Manjari to Mahinje to Koregaon Park. So very exciting launch calendars ahead. There is a very high degree of probability that we will, of course, meet our guidance. And there is a reasonable probability that we might even exceed our guidance. So, but we're not really changing our guidance. It's too early because real estate sales are very lumpy depending on approvals. But yes, fingers crossed, we have a very exciting year ahead.
Yeah, it looks like from the numbers. Gaurav, the other thing that is strong in this particular quarter is your operating cash flows. They have surged 8 times on a YY basis. Customer inflows have increased 54% on a YY basis. The spends on land and approvals, they're up 25% on a YY basis. This is to a near record high levels. Tell us, what will these numbers look like by the end of this year, considering that you're looking at a lot of land acquisitions? And what is the collection efficiency right now? Is it better than the industry for you?
Great. That's a great question, actually. So if you look at a journey from a collections point of view, we did about close to 2,000 crores a year back in Q1. As you rightly said, it's grown by 50% to about 3,000 plus crores of collections, which is why our operating cash flows now stands about 988 crores, which is a record ever from a Q1 point of view. And this is all going to fuel our business development opportunities, and we will continue to see great collection curve. Our guidance for the year is 15,000 crores of collections. And collections, you would appreciate, normally, again, is linked to projects which are late stage in terms of completion. You get lumpier collections. So we will have a lot of OCs coming to the later part of the year. So collections curve will, of course, shoot more strongly to the later part of the year. And we are reasonably confident on a guidance of 15,000 crores of collections. With that, I think we have a lot of headroom to do more exciting stuff on the business development side, which is why you saw even 2 announcements in Q1 happening on the BD side, one in Bangalore as well, and one in Pune. So yeah, we will see a similar happening in this quarter. Starting with Indore, we were done already 1 announcement. So yeah, great collections is leading to great operating cash flows, which we are kind of churning back to business development.
So, your debt has still increased on a quarter-on-quarter basis. So, will most of this be funded via debt or internal accruals? Because even your cash flows are strong right now. How do you balance the two?
I think it'll be a combination, right? I mean, we've given for the last 7-8 earnings call, we've maintained that our guidance from where we want to operate from a net debt is to equity is between 0.5 range to 1:1. Right now, in almost the middle of the range, we're about 0.71 by end of Q1. So yes, there is, to begin with, a significant opportunity available within the debt headroom, but there is always going to be more and more operating cash flows available to fuel growth. So it's a combination of when do we want to use which part of the capital to fuel growth. But yes, it's going to be a combination.
Gaurav, we are speaking just after the budget, and there's been that big change in taxation for property sales. The long-term capital gains cut to 12.5%, but indexation taken away. Do you think that is something that could impact sales going forward? Because, it would work only if the price rise is more than 11%, would be beneficial for any seller. And that has not been the case largely in the real estate industry. What do you make of this move?
I think, so let me divide, buyers into maybe two broad categories. I mean, one can segment the customers into many more categories, but just to make it slightly more easier to understand, let's say you are a buyer which is 10 to 20-year-old kind of a period of time. Removal of indexation will probably it may impact you the most, right? But usually if you see people with holding periods of 10 to 20 years are either people who are end users who want to now upgrade to the homes. Usually those are the bucket who hold beyond 10 years as one of the buckets. And these people will be agnostic to the change. Why? Because when you upgrade, LTCG doesn't really impact you because it impacts you if you withdraw. And then the second bucket of investors, which is looking at equity multiple, like wealth creation, generational wealth kind of category of investors. Again, this actually make it a little more stickier to the sector because yes, you lose on the indexation, but the way to prevent is you buy property again. So I think those two categories would have been largely impacted, but mostly 80 to 90% of those are either end users or equity multiple oriented kind of generational wealth kind of investors. On the short term, actually, it might be a bit of a good positive surprise because if your holding period like this 5, 6, 7 years, generally indexation doesn't make huge of a difference, but it would actually make it either neutral, slightly better in the case if you reduce your timeline to say about 4 to 7 years of investment. Why? Because one, you get the benefit of lower LTCG, and to top it off, this theory in our mind that when we look at asset classes for comparables, we tend to look at equity differently from an investment thesis versus this. Here, actually, have a benefit that it becomes exactly comparable. So your return thresholds to assess risk and reward becomes very easy to do. And on top of it, if at all you feel the cycle is riding on through even 4 to 7 years, you can always prevent capital gains tax by reinvesting the property and take the benefit of compounding, which in many sectors you don't get it. So I think there is a lot of nuance to what people are initially interpreting it. But with time, 6 months, 12 months, you will realize people will understand the meaning of it and it might have a positive impact. At the moment, I would say, given the noise, it's best to assume it's neutral. But I have a feeling that in the long run, when people will understand the logic, it might turn out to be an interesting surprise.
Okay, thanks a lot for that and all the best for the next couple of quarters. That is Godrej Properties.